Thank you for joining us. My name is Matt Hilland. I'm a financial planner here at Arnold Remote Wealth Management, and this is our final webinar for 2024. And we're going to be looking ahead to next year and talking about a few tax changes, changes to retirement savings, and planning opportunities that exist in 2025. In general, 2025 is a pretty quiet year relative to what we've been used to the last few years, at least. The one big change involves 401k savings, or also maybe 403b, your big retirement account that you might have available to you with your employer. In general, there's a small increase in the amount that you can contribute. For 2025, that's getting a $500 increase up to $23,500. The big change is for those who are within a very specific age range. So if you are between ages 60 and 63 in 2025, or more specifically, if you turn one of those ages in 2025, there's a special catch-up contribution for you. This is in excess of the normal catch-up contribution that's always existed for those over a certain age. So this is I don't know what to call it, a special catch-up contribution. And to try to just show this in a little better detail, here is what the annual 401k savings amounts are based on your age. And so what is new for 2025 is this bolded row here, a special catch-up amount for those who are age 60 to 63. But it's kind of confusing. You have to turn that age in 2025. And so what might be more clear is if you were born between 1962 and 1965, this is going to apply to you in 2025. And you can see there's a few extra $1,000 that you can put into a 401k in 2025. And then, regardless of your age, I think this chart's helpful just to show what your annual savings limit is into your retirement account, and then how much you would need to contribute either monthly or bi-monthly or bi-weekly, depending on how you're paid. So look at your first pay stub here in 2025, see the amount that is being deducted, and if your plan is to uh, max out the contribution for your 401k this year. Hopefully, these numbers are helpful just as a little guideline for what you should be seeing coming out of your paycheck from your contribution each check. And then continuing on with the retirement savings, of course, there's traditional IRAs and Roth IRAs also that you have the option to save into. And so there is no change to that contribution limit this year. So if you are under age 50, that contribution amount remains at $7,000. If you are over age 50, you get that extra $1,000 catch-up contribution, so you can do $8,000 for an IRA or Roth IRA in 2025. And then again, I just put that per month amount since for a lot of people, it's nice to just set up an automatic monthly contribution, put this on autopilot. And if that's what you'd like to do here, set that up for either about 583 a month or 666 a month, and just have that kind of maxed out automatically. And then something else that changes each year is a small inflation adjustment on the income that you have to stay under to be eligible to do a Roth IRA contribution. And so here you can see for 2025, if you're a married household, you need a modified adjusted gross income of 236,000 or less to be able to do that full contribution limit. If you're single, that's $150,000. And there is a small phase out window here, but in general, have these numbers in mind, either 236,000 or 150,000. If you know you're close to that, pay extra attention to see if you can do anything to reduce your income, such as maybe more pre-tax 401k savings, taking advantage of HSA, something like that to open up that full Roth contribution amount. And likewise, HSAs, as a reminder, we see HSAs really as a really nice retirement savings account. If you need the money for health expenses, that's great. But if you can put money in an HSA and leave it there for decades to grow and compound, there's a ton of benefits. We view HSAs similar to like Roth IRAs, where if you can let that sit for a while, that's perfect. And so for a lot of people, taking full advantage of HSA contribution amounts is one of your highest priorities for retirement savings. And one thing that's confusing on HSAs is the catch-up addition to how much you can save to an HSA is age 55, not age 50 like you saw on the IRAs and Roth IRAs. So age 55 is when you can start putting a little bit more into HSAs. So if you're turning 55 this year, double check your payroll that you're kind of taking advantage of this new amount that you can contribute. And again, there's a small increase in what you can contribute to an HSA this year from last year, about $150 or $250, depending on if you're single or have a family high deductible health plan here. And again, like previous slides, I've put kind of broken down these savings amounts either per month, if you're paid twice per month or bi-weekly, what you should look for coming out of your check each pay period. And one interesting note just on HSAs, you have some flexibility in how you can fund these. You know, you can just fund them directly through payroll. You can also contribute money just from your checking account if you want. One kind of interesting benefit here, if you fund your HSA through your payroll, it helps you avoid the FICA taxes. So this is like your Social Security and Medicare taxes on your income. If you set up your HSA to be funded directly through your payroll, that amount, you know, whether it be 8550 or 9550, is not subject to FICA taxes. If you instead get paid that amount and then write a $9,500 check into your HSA, that then under that scenario, that 9,500 will be subject to FICA taxes. And so maybe just saying probably for most a little bit of benefit in using payroll to fund the HSA if you can. And then something that changes every year is the federal income tax brackets. And so here we're looking at those tax brackets both for married on the left-hand side, single filers on the right-hand side. There's no big changes here, but there are just some general inflation adjustments here as well. And there's a couple things that we like to point out here, and there's a few areas in the tax code that have relatively big jumps in income. So, for example, a married household who has income just a little bit over $94,000, all of a sudden you see an instantaneous kind of 10% jump in any additional income. Likewise, those higher income, you know, say you're about 384,000 in income, there's this 8% jump here that's kind of steep. And so these are some levels that we look at, you know, as far as if your taxable income is around this amount. So here again, if you're looking, you probably know your gross salary, your spouse's gross salary. If those two numbers are getting close to, you know, just barely exceeding 94,000, just barely exceeding 384,000, it might be worth a look and say, you know, should we switch around some of our retirement savings to avoid getting into this next bucket here? And again, there's no 100% answer for everyone here. Sometimes it's still worth saving into you know, Roth if you're just getting into 22% or just getting into 32. But it's a decision point there that, you know that you're close to some of these big tax jumps, and it's worth spending a little extra time to plan if it's worth trying to get more deductions to avoid getting into these higher income tax brackets. And then the one caveat here is, as of now, the Tax Cut and Job Act is set to sunset at the end of 2025, and 2026 will see very different tax brackets and what tends to be a small tax increase for a lot of people. Of course, the election kind of made some people a little bit more optimistic that current tax brackets will stay as they are, but nothing's written in stone. And I will say the law is written to automatically change these tax brackets quite a bit unless Congress can settle on something else. And so might be something just worth tuning into and seeing how legislation goes this year regarding tax brackets. Something else that applies to a lot of our retiree clients is the IRMAA brackets. And so this is the surcharge that's on your Medicare premiums, and it's dependent on a modified adjusted gross income. So this is not taxable income like the income tax brackets. And so what you're looking at here is again, a table for whether or not you're married on the left side or single on the right-hand side, and income levels, and then what your Part B Medicare premium will be each month depending on your income. And so what's always confusing is this is based on your income from 2 years prior. So for 2025, you want to look at or Social Security and Medicare are going to be looking at your 2023 income. And if in 2023 you earned $300,000 in modified adjusted gross income, each spouse will be paying $370 per month for their Medicare. And so this is, a couple things here. One, if you had high income in 2023 and don't in 2025 due to certain things like retiring, there are ways to appeal this. So you should know this because this can be a pretty expensive surcharge. You can see, for example, in this kind of bracket here, we're doubling the cost of your Medicare. Uh, Also, this is a good basis for planning for the future. And so your income in 2025 will apply to the 2027 IRMAA brackets. And these do get a small inflation adjustment, but generally just to be conservative, if you're looking at doing Roth conversions or something like that, you want to check and make sure maybe you're not setting yourself up to have a modified adjusted gross income of $336,000, just barely getting in one of these brackets here. It's something to be aware of in 2025 because it can have an impact a couple of years from now. And of course, once you recognize that income, you can't go back and undo it. And another big planning item that comes up here with IRMAA, this is something that's commonly triggered on purpose for doing Roth conversions. Roth conversions add income that contributes to your modified adjusted gross income and can trigger IRMAA. And sometimes that's tough for people to accept, right? You never want to feel like you're paying more in taxes than you should. Something that I think is interesting and maybe worth considering is that a lot of times, when we're talking Roth conversions with people, it's pay taxes now so you don't have to pay later. And that also generally means pay IRMAA now so you don't have to pay IRMAA later. And something just to add a little bit to that point is that we've been seeing that IRMAA surcharge increase a little bit higher for higher income people than the general Medicare Part B premium uh, has increased over time. And so just for example here, I'm showing when IRMAA was first started in 2007, the lowest Part B premium was $93.50. Today, Part B is $185. That's an increase of just about 4.0% annually. However, if you're higher income, you've seen your IRMAA costs increase more than double that. And so, again, just to explain the tables here, what you're looking at, the highest income bracket for IRMAA in 2007 would have resulted in a monthly Medicare Part B premium of $161 in 2007. Today, it's almost $629 per month. And again, if this trend continues, if you start thinking about 8% plus compounding, even a retiree who's 65 today very well could be looking at 20 years, 25 years in the Medicare system, compounding a cost at 8.3% gets some pretty high numbers later on in life. And again, I think just helps tip the scales a little bit to the benefit of doing Roth conversions now and getting rid of some of that uncertainty about what the Medicare system will look like 20 or 30 years from now. For those on Social Security, you get a cost of living adjustment this year, of course. It's lower than what we've seen in the last few years. It will be 2.5%. That can be a good thing. It means inflation's coming down, but certainly less than if you've gotten used to some of those higher increases in prior years, something to know about. And then something that is not inflation adjusted is the determination for how your Social Security is taxed. And this this ends up, because it's not inflation adjusted, ends up kind of hitting different people every year. And so if you are a married household with um, what's called combined income of 44,000 or so, 85% of your Social Security is taxed. As that income reduces, um, less and less of your Social Security becomes taxed at all. And that combined income is a little bit of a confusing definition. In general, it's your AGI plus half of your Social Security benefit, uh, but it can be, again, kind of confusing to calculate. And there's a lot of moving parts and what contributes to that. And so we have found some scenarios with clients that lead to very surprising tax bills for those people that don't feel like they should be. And so this is a chart here on the x-axis here is additional income, and on the y-axis is kind of your total federal tax rate. And so this is something that we look at internally for clients as we try to determine the tax impact of taking additional income, whether it's doing Roth conversions, doing added IRA withdrawals, recognizing capital gains. And I just wanted to show this because this is um, a chart here for someone that tends to not think of themselves as very high income. So this is a household with 46,000 in gross Social Security benefits, relatively small IRA required distributions, relatively small pension, modest amounts of interest and dividends. And they're in a position where just in this case, about $11,000 in added income or maybe added IRA withdrawals or Roth conversions can result in an effective tax rate of about 41%. And this doesn't have to mean just for very low income people. There's a lot of people with very big IRA balances but are living off of cash or things that don't contribute to their taxable income and think that they're being smart by, oh, hey, I'll just do a $20,000 IRA withdrawal, not realizing that it's causing a lot of your Social Security to be taxable, and you end up with this 40+% effective tax rate. And so this tends to impact those that are relying very heavily on their Social Security and then a small amount on IRAs or annuities or pensions. And so I just highlight this here. It can be a little bit complex to calculate for you, but if you're in a position where your Social Security is a relatively high amount, you delayed until your late 60s or 70s, and you don't have a lot of other income, it's worth looking at some of this in much more detail and make sure you're not accidentally triggering these really high effective tax rates for yourself. A couple other minor things in 2025. This is not new in 2025, but is new in the last couple of years, so I just like to revisit it. QCDs or qualified charitable distributions. These are donations you can do directly from your IRA to reduce your RMD or just get money tax-free out of your IRA for donations. Beginning last year, this started being inflation adjusted, and so for a long, long time, the QCD limit was $100,000 a year. For 2025, now it's 108,000. So if you are one of those that are kind of maxing out that QCD amount, you have a little bit extra room here in 2025. And then likewise, there was a new provision in the Secure Act that made QCDs able to fund charitable gift annuities, and that is the limit that you can do that for is also now inflation adjusted, and so that is $54,000 for 2025. I'm these are complex topics here. I'm blowing through this really quick. Our prior webinar for was in November of 2024 was talking about charitable uh, strategies in a lot more detail. And so I'd say look into that if you are charitable and are interested in learning how your IRA can be used for charitable means. And if that's really interesting to you, then this is when this is going to start applying. And then the one thing to start, I think, planning for in 2025, but doesn't actually go into effect until 2026, is that as of now, how the law is written, if your wages from your employer are over $145,000 this year, it will be required that any catch-up contributions you do for your 401k go on the Roth side. And that 145,000 is the amount that was listed in Secure Act. It is inflation adjusted, but because this has been delayed, I haven't seen official amounts, but it should be about $157,000 in 2025. And so if you are someone that's been taking full advantage of your 401k, those catch-up contributions, and your income is close to $157,000, this might be something really worth looking into because you're going to be required to effectively pay taxes on some amount of money that you are used to not in prior years. And unfortunately, the way this wages is defined um, is pretty general and makes it hard to reduce this amount. So this is not like taxable income where you can have big deductions like for your uh, retirement account contributions, that $30,000 you can put in your 401k. That does not lower what's referred to as your wages here. There's very few options to reduce that, but a couple of those here are HSA contributions through your payroll. There's an asterisk here. Again, if you fund it through your checking account, it won't apply. And not every HSA is set up to, I guess, come out correctly for this. And so again, I'm highlighting here that if your income is close to this 157,000 amount and you would really like to make pre-tax 401k contributions next year, it might be worth looking into how your HSA contributions are recorded on your W-2 and see if that can lower what's called your wages here. FSA, if you're using a flexible spending account, that can reduce it. If you have a dependent care FSA, that's the $5,000 you can contribute that go towards childcare costs. That will reduce your wages. Uh, Again, complex topic to figure out exactly if this is something that impacts you, if it's something you should be worried about. Right here, I'm trying to flag if your income is in around this window of 157,000 and you would like to do pre-tax 401k contributions, it's worth looking at how we can reduce your income in 2025. Uh, One final thing here, something that is not new in 2025, but there's some concern that this could go away after 2025 is some tax credits that are available for those purchasing an electric car. And so as a reminder, there's up to $7,500 in potential tax credits, uh, depending on the type of car that you buy. Lots of regulation here in fine print. But again, I'm trying to highlight those that have income within certain windows here. So you can see about $300,000 for married couples, $150,000 for other filers. If you are considering buying an electric vehicle in 2025 and your income is around these numbers here, it might be very beneficial to figure out how to keep your income or your AGI here under these amounts so that you can qualify for what is a pretty big tax credit. And again, there's some concern here that with the election, this credit will not last, and so there's a little bit of a rush. People that were on the fence about purchasing an electric car trying to take advantage of this credit this year. Um, Finally, not necessarily related to 2025, but since this is the last time we'll be in front of many of you for 2024, just wanted to offer a very basic checklist for some year-end items. One, tax loss harvesting. If it's beneficial for you, you have just a couple weeks here to recognize those losses. Many bond funds have had a little bit of a dip here in the last few months. Also, small cap international stocks in particular are down. And so if you hold general bond funds, small cap international, you might be in a brokerage account. You might be able to recognize some of those losses and get yourself up to a $3,000 tax deduction this year. Again, very complex topic. We have a whole webinar on this issue that you can search for if you want to learn more, or of course, reach out to us. For clients, know that we're doing this for you automatically. FSAs, some FSA money may be able to be rolled over, but it's not guaranteed. So double check you've used your FSA, or it's very clear how much will roll over if you don't use it. QCD or qualified charitable distribution checks have to be cashed before year end. So if you write that check December 30th and the charity doesn't cash it until January 2nd, it applies for next year. If you're getting close to the deadline here, we can have Schwab, for our clients, we can have Schwab actually cut the check and get the money deducted from your account. So you're not at the mercy of when the charity cashes the check. And so this is something, yeah, if you have your QCD checkbook, write those checks sooner rather than later. If you're worried about your charity being slow to cash that, please contact us right away so that we can get Schwab to write the check and deduct that money from your account to make sure it counts for this year. Roth conversions, there's always a little bit of confusion because Roth contributions have an April deadline, April of the next tax year deadline. Roth conversions, though, must be done by December 31st. Likewise, 529 contributions for the majority of states have to be done by December 31st. Iowa has an April deadline, which is really, really nice. So for those of us in Iowa here, you have a little bit of extra time, but if you're saving to a 529 in other states, you very likely have a December 31st deadline to do that. So that's all. Thanks again. I hope this helped highlight what parts of the tax code in 2025 is applicable for you. It's really hard to do an exhaustive webinar here on tax brackets and IRMAA and electric vehicle credits and all that. But hopefully this helped highlight those that are in position to have some potentially very valuable benefits and doing some more in-depth planning here. And so of course, if you have any questions, please reach out. We're here at the office today to take a phone call. You can comment in the video here and we'll get back to you, or of course, send us an email. If we don't see you or talk to you before the end of the year, happy holidays and happy new year. And thanks as always. Bye-bye.